Welcome back to the channel. In this video, I want to show you how 2 sizable car loans can be paid off in 9 months. You'll see how the numbers compare using several debt strategies including doing nothing, the debt snowball, debt avalanche, rolling payments, and velocity banking methods all in one spreadsheet. But you'll see why it's so important to check each method before starting a loan payoff plan. Because one of these popular strategies may be fastest but comes at a higher cost. Here's the scenario. This person has 2 car loan balances to pay off. The total balance is $52,805. One has an interest rate of almost 6% and the other at 3.4%. The person also has a monthly income of $9,400, other expenses of $5,672, and cash flow of $2,602. And they're thinking about using a line of credit as the strategy to pay both off. We'll see if that's a good idea. Let's go to the Debt Strategy Payoff tool and enter these outstanding debts in the Your Data tab. I'll enter the quick description, balance, interest, and monthly payment for the debts. These are all easily found on each statement. One option this person has is to utilize an available line of credit. It would be $15,000 at an interest rate of 11.99%. Let's go ahead and enter these amounts in the line of credit section as well. And that's everything. We can now go to the Dashboard tab, enter the date we want to start, and see how the payoff methods compare. In the Start Date cell near the top of the screen, let's enter a start date of January 1st, 2024. And let's start by checking to make sure the line of credit button is selected for the velocity banking method. And the Excel spreadsheet automatically calculates the results to compare 5 different methods to pay off the debt. We'll see results if the person does nothing, uses the debt snowball, debt avalanche, rolling payments, and velocity banking. Let's quickly look at all the methods. The first is doing nothing. This shows the total time frame and interests costs to pay down both car loans at the minimum payment amounts. This is exactly how the banks want you to pay the loan back because it maximizes their profits. Next is a popular method, the debt snowball, where the debts are sequenced by the balance amounts. Everything is paid back starting with the smallest balance to the largest, regardless of interest rates. The debt avalanche is another well-known method where the debts are sequenced by interest rates. The debts are paid back starting with the one with the largest interest rate, working your way down to the smallest interest rate, regardless of balance. For rolling payments, the concept is very simple yet not well known. The idea with rolling payments is to pay off the minimums amount until one of the debts is paid off. Then you take that minimum payment and add it to the next shortest payment time frame. You keep rolling the payments from the paid-off debts into the next one. All the debts are sequenced by timing, specifically shortest to longest time frame based on the minimum payment amount. This strategy is very similar to debt snowball and debt avalanche, except it completely ignores the interest rates. It sequences purely based on timing to a zero balance. The velocity banking method has 2 parts that utilize available credit to help pay down the debts. One part is to use available credit from a credit card, and the second part is using a line of credit to pay down the debts. Frequently, full incomes and expenses are rolled into the credit as a means of lowering the interest costs. So let's look at the dashboard and see what our starting numbers look like. We can see the debt totals $52,805, would cost $6,419 in interest and take 57 months if we did nothing but pay off the minimum payments each month. So this is our baseline. The goal is to see what method improves from this initial starting point. We can see right away that the debt snowball and rolling payments method are slightly better at 4 months less to pay off and almost $100 cheaper. But looking at the velocity banking method, it's 7 months shorter but costs almost $4,000 more. Now there are several ways to utilize velocity banking and lines of credit, not just how the spreadsheet calculates it. Right now, this does not roll in the person's income and expenses into the calculation. It's a straightforward attempt to knock balances down quicker, which did happen, but at a much higher cost. Now let's see if we include just the extra cash flow this person has each month. We'll add the full amount, $2,602 here. And in the velocity banking section, we first need to account for the difference between the automatic interest payments for the line of credit and the total cash flow. So we'll subtract $180 from $2,602 since the tool automatically updates the payments when the line of credit is used, which equals $2,422, and add it in the velocity banking section. Whoa! Now look at that. That's a huge improvement. You can see all the monthly payments are the same at $3,728. But look how much time was taken off. Now we're at only 15 months to pay off both loans with the debt avalanche method at the cheapest interest cost. Velocity banking is only 1 month longer but over $2,000 more expensive. Yes, $2,000 more expensive. That's a significant cost just for using the line of credit. Remember, this person is thinking about using velocity banking to pay off the cars. At this point, that would be the worst option. They'd be better off doing nothing than using the line of credit. But yes, there are other ways to use velocity banking. So now let's add the income and expenses into the picture with the line of credit and see if that helps in any way. First, we want our total monthly payments in the velocity banking section to equal this person's income of $9,400. So we subtract the original payments of $1,306 from $9,400, which equals $8,094, and enter that amount here in the additional monthly payments cell. We can confirm the monthly payments equal the full income of $9,400. Now we go to the Your Data tab to add our other monthly expenses in. We'll add $5,672 in the expenses cell here, and now we can go back to the dashboard to see how things changed. So here are the final results. Adding income and expenses to the velocity banking method does have a big impact on the timeline. Using the line of credit, it's down to 9 months. Remember that it was originally going to take 53 months to pay off all $53,000. That's a huge reduction. And debt snowball, debt avalanche, and rolling payments are next best at 15 months. But here's where it gets interesting. Velocity banking is almost $300 more expensive than the other methods. Debt avalanche is the cheapest way to pay off these car loans. Ultimately, this scenario comes down to what is most important for the person. Is time more important? Or is cost? If this person wants to pay off their debt as soon as possible and willing to pay a little more, then velocity banking is the method to choose. But if cost is the key issue and the person is willing to extend the time frame a little longer, the debt avalanche is the best method. The beauty of this calculator is you can really compare all your particular nuances with your exact debt. And it enables you to make a decision that is in your best interests. And you can clearly see the benefits of each method over doing nothing and just paying off the minimum each month. This spreadsheet shows that velocity banking could work in certain situations. But there are also alternatives that can save more money. And if you're going to use a line of credit, it's critical to understand the benefits and drawbacks. As you saw in this example, if the line of credit is not closely watched or used incorrectly, it could cost thousands more than this person thought. One note we have is to make sure you consider the effort needed to obtain a line of credit. If you don't already have one, it will take time, paperwork, and appointments to finally get approved. If you already have a line of credit, then you can use any balance you have available. Also, this spreadsheet shows just 2 ways to use velocity banking. But in reality, there are more ways to utilize the velocity banking strategy that may also give different results. Lastly, on the line of credit, you need to be extremely diligent when transitioning with bringing in your income and other expenses into the line of credit monthly payments. In this example, we use the entire available line of credit amount to help reduce the car loan debt. However, you should consider leaving 1 month's worth of expenses as available credit so your transition from month to month is smooth. On this channel, our goal is to help everyone see how important it is to calculate the true cost and time frame of each method to realize their options when it comes to paying off debt. There is no one best strategy that fits every case. As this example showed, there may be a couple different approaches depending on what is a greater priority for you. And this is why it's so crucial to run the numbers using your own specific debts and details so you can make an informed decision on how to tackle your debt. We hope this helps show how essential but easy it can be to figure out the best method as you work toward financial relief. Thank you so much for watching, and please leave a like and comment on this video if you found it to be useful.